morning. We will start the webinar now. Okay, so we are going to give an update on the results that was announced last week. So there's a Soybean Wheat, First Wheat, and Fraser Center Bond Trust. So first is we're going to start with Soybean Business-Based Wheat. The top table shows the 4Q results for FY15 versus FY14. The bottom table is the full year results. So it was a acquisition-driven year. For 4Q15, there was higher gross revenue mainly from the acquisitions of KTL Offshore, Tech and Techniques, which was acquired in 4Q14 and 2Q15. So there's a DPU of 1.614 cents declared for 4Q. Ex-date will be 27 January. On a full year basis, same thing, gross revenue was higher year on year, again from acquisitions. Net property income also higher. You can see that mainly from acquisitions of properties that are master leases. So the margin, the NPI margin for master leases is higher than the NPI margin for multi-tenanted. So the update on the portfolio still has a high occupancy of 96.8% and a long WALE of 4.8 years. In terms of interest rate risk and refinancing, it's quite limited. The gearing is at 36%. The MAS maximum is 45. And they do not have any refinancing until 2018. And they have an estimated interest cover ratio of 3.9 times for FY16. So some of the concerns would be one of their exposure to the oil and gas sector. So actually for one of their largest properties, which is Techniques Offshore, the manager feedback that the tenant is not in arrears and they have prompt in making payment. And also that this property, upfront they've already collected 18 months security deposit when they did the sale and leaseback for this property. Second point is that the manager is committed to maintaining portfolio occupancy. So the manager may have to lower rents for this year for the leases that are expiring in order to maintain occupancy. The priority is to retain tenants, because if they allow the tenants to shift out, they may not be able to find replacement tenants. The other thing for the acquisition front is Bukit Batok Connection, which is from their sponsors, Rover. So this property is a 9-story ramp-up building, and the NLA is about 380,000 square feet. So this would potentially increase the existing portfolio's NLA by 11%. Okay, so looking forward also, this year, 2016, the REIT highly likely will have to do acquisition, because without acquisition, they're going to have flat to negative DPU growth. And for this REIT, the manager's base fee and performance fee are there's an alignment of interest with unit holders, because for their base fee is a percentage of distributor income, and the performance fee is a percentage of the increase in the annual DPU, which is different from most of other industrial REITs where base fee is on AUM and the performance fee is based on MPI. So in this regard, the manager is incentivized to actually grow the DPU, and it looks like the only way to do that this year is to make an acquisition for earn his performance fee. Otherwise, he'll just collect his base fee. So at the end of the year, the REIT also does the revaluation of the properties. And if you look at this table, it shows that the asset values have held up. You can see this column is so the end of the year, 4Q, and this is receiving that, so that is the third quarter. So this has been in spite of the overall weakness in the leasing market. And I think it's for two reasons, because most of their properties are on master leases, so the rental income rate has been locked in already. And if you look at the report, there's a map there, I put a map there. Actually, their properties mostly are clustered around Jurong Port and the future Tuas Port, which will be opening in 2022. So lastly, on a relative valuation basis, this table shows some of their peer comparisons, and their price to NAV at 0.91 is currently lower than the sector average, and they have a yield that is higher than the sector average as well. In terms of its own historical valuation, it's now at minus 2 standard deviation from its price to book. So it's looking quite compelling now. The thing about the price to book, as I showed in the previous slide, actually the asset value has held up quite well already. So I think that there should be limited downside on the book value from that point of view. Okay, we'll move on to first REIT.
Okay, thanks, Richard. So we move on to first REIT. I'll go through the numbers first. It's their full year earnings that were just reported. So for the financial year 15, revenue was up 8%, but primarily it was driven by, because they made new acquisitions at the end of 2014, and they made acquisitions in the second half of last year as well. Because we know that first REIT, their rentals, organic growth is pegged to Singapore CPI, and Singapore CPI last year was flat. So organic growth nothing much, a lot of it due to acquisitions. So you see that revenue grew 8%, a lot of it flowed down all the way to distributable income, but EPU grew 3.1% because of the increase in number of units issued. So some operational updates. You see that gearing remains at a relatively lower level than what management is comfortable. So latest gearing is at 34%. They still have majority of their debt hedged on fixed rate, around 89%. Portfolio valuation last year up 2%, net of new acquisitions. And NAV at latest FY is 1.04. So at current price, it's trading about 1.15 price to book. So during the luncheon, management was quick to offer their thoughts. I think they are also aware that one of the biggest hangovers of this week is that in the last few months there were reports of the sponsor trying to list the REIT in Indonesia instead. And then there were news about Indonesia trying to make the market more conducive for REIT listings. So management was saying there were as much as what we have said in our last reports. They think that a lot of hurdles are present in this move. Like first of which, the banking covenants in the REITs, in the loans that they have, the Sing dollar loans that they have, it stipulates that if a delisting were to occur, the management will have to buy out reclaim all the loans, the Sing dollar loans. So that would mean that the sponsor would have to reissue loans in rupiah terms, which would mean that there will be higher borrowing costs. Then secondly, because of the fragmented shareholding structure of First REIT, if you want to delist it, rather than just convincing a few majority shareholders, very likely you would have to offer a very good premium, because so as to get 90% so that you can delist it. So it wouldn't be easy, it wouldn't come easy. And then lastly, because Indonesia's REIT market is not as developed as ours. So in a market which is not as developed, in a market where risk-free rates are higher, your investors typically would demand higher returns. So if you were to list your REITs there, with the higher return that investors would demand, it is less easy for the REIT to make equity valuations. So with all these hurdles, management was skeptical on the move. But one of the biggest concerns is that even though they were to list the dispute in Singapore, because of the easier conditions in Indonesia, so there are possibly more options for the sponsor to recycle their capital. So one of the concerns would be that the slowdown in the rate of passing down of assets. And 2 weeks ago, the sponsor was also flagged out by the credit rating agencies in that they say that the sponsor has been slow to pass down their assets to the REITs. So that kind of affected their cash flows, and then that was why the sponsor was flagged out. So when this issue was raised with management, they actually kind of reaffirmed that in 2016, they still have very firm acquisition plans on track. So they listed some of the pipeline properties. So out of all these properties, a lot of them are still under construction. Some of them they have teething issues, such as like there are minority shareholders in the hospitals, some of whom are the doctors working in the hospitals. So for the management to convince the doctors to sell out their stake results. So these are some of the issues that they face. But they have already earmarked 3 hospitals for acquisitions, Yogyakarta and the first 2 on the list. Typically, they do acquisitions in the range of 75 to 100 million Sing dollars. So for 2016, what they are planning is nothing different from what they have done. And we think that with this kind of outlook and clarity on the acquisition, actually remove some of the uncertainty in the market. You know that market doesn't like uncertainty. So this actually kind of improves the visibility and the outlook for the REIT. So for that, we still maintain our buy call, the target price of 138. And next we move on to Fraser Center Point. Some of the operational metrics before we move on to more in-depth stuff. So first Q16, flat revenue, no acquisitions last year, but on the back of flat revenue, they were able to grow MPI by 1.8%, primarily because oil price is down, so lower utility bills for the malls, and then lower maintenance bills, lower replacement works bills as well. So DPU grew 4.4% year on year. I think 2 eye-catching metrics that they reported were that rental reversions went up 13%. In a mature market like this, you can do 13% is pretty spectacular. And traffic flow was up 8% for mature malls, which was pretty spectacular as well. But these are metrics which are likely to be more one-off than sustainable. So the rental reversion was more due to the reconfiguration of the tenant mix in North Point as they try to undergo a transition as they are trying to do an AEI on the mall. And the increase in footfall 8% is primarily due to North Point as well, because they are doing some redirectioning of the footfall in the Yishun area. So they are re-guiding the traffic more towards, they have to pass the shops before they want to go to the transport hubs. So the reconfiguration actually led to increased footfall. But that being said, the increase in footfall actually did not translate to better sales. So we know that for last year, Singapore's retail sales was actually pretty sluggish. If you look at headline numbers, you see pretty numbers like up 3%, 4%. But if you strip out car sales, the underlying retail figures is actually flat or slightly negative. It seems like Singaporeans they have money to buy cars, but not anything else. I think primarily also because the COE dropped from near 70k to 45k. So for FCT, we see that for the past 4 quarters, tenant sales have been dropping. 1Q15 was up 4.8% year on year. This quarter we had only up 1.9%, dropping for the past 4 quarters. And occupancy is slightly down as well. So occupancy, primarily the two big malls are still doing fine, but mainly dragged down by the two malls, that is Phillip Point and Changi City Point. Changi City Point we mentioned because of the MRT road downtown line. Phillip Point has always been weak, and we know about it since many quarters ago. So what they are going to do for this year is they're going to undergo a major renovation work to North Point. So it's going to be 18 months long, and the impact on this on the portfolio is that management has guided that occupancy for this period, the average is going to dip to 76%. So given that North Point actually contributes 1/3 of the NPI for FCT, this is going to be a big hit. So, but we think that this is a short-term gain, long-term gain, because previously the most major AEI that management has done, and that is on Causeway Point, they managed to achieve a 13% ROI. So we are confident of the track record of the management doing AEI, but we think that nonetheless this is going to be a big hit on the MPI level, and so we forecast a 10% down for the full year NPI for this year. Nonetheless, we think that this is a necessary move because in 2018, when North Point City comes on, the new North Point City Mall is going to be linked to the current North Point. So the move is actually to improve the facade of North Point, which actually looks kind of old as well, for those guys who know. And the move actually can facilitate linkage to the future North Point City as well, which is going to be the biggest mall in the north of Singapore. And North Point City, together with North Point Residences, have actually sold pretty well, so that area, the footfall is going to be sustainable, even with increased NLA in the future. So for FCT, if you look at current dividend yield, it's doing about 6.2%. If you look at the average for the last 5 years, it's 5.7%. Even if you look at average from mid of 2013, that was when our risk rates went up close to where we are now. So if you look at average for last 5 years, 5.7, average from middle of 2013, where risk rates actually went up. So you would expect then yields of correspondingly go up as well. That average from that point is actually about 5.9%. So at current price of at current yield of 6.2, I think a lot of the slowing growth in the DPU has been priced in, and there is actually room for yield compression down to the average level. So with that, we maintain our accumulate call on FCT and target price $2. So for the other retail mall that just announced results last week, CMT, I think general consensus is that on the ground there is a lot of headwinds from the retail side. So CMT, they had rental reversions of about 3.3+% for the last FY, and that reversion is actually weakest since 2009. So management has also guided that they are likely to see negative reversions in the coming quarters, but for the full year, they are still confident of positive growth, but a lot of it needs to be. As for island-wide malls, they are doing pretty fine, it's just that reversions are getting weaker, but the malls at the western side of Singapore
Hi, good morning. There's a question on Soybook REIT. So the question is, outlook is good, but then would the increasing warehouse space in 2006 and 7 impact rental rates for Soybook REIT? So we mentioned in our slides, and as per our talks with management, we understand that this 1 or 2 years with the ramp up in supply, there will be headwinds, there will be pressure, and management is committed to maintain portfolio occupancy, and in fact, they're prepared to lower rents to maintain occupancy. But we are playing on a long-term decentralization theme for Solid REIT, based on the fact that a lot of corporations are moving out from CBD to business parks in the more suburban areas. So we are looking at the supply, the pressure to taper off after the huge supply coming these 2 years. Hi, there's a question on the S-REIT sector with the average yield now at 7.6%, and then with the expectation that the Fed is going to increase rates. Would it be better to stick to higher paying yield REITs trading at a bigger discount to NAV? Like for instance, Fraser's Commercial, which is trading at 20 plus percent rather than FCT. So so you're right in saying that a lot of office REITs now they are trading at a big discount to their NAV. You have even your big boys like Capital Commercial, Capital REIT. they're trading at 30%, 30, 20 or 30% discount to book. But the reason why retail REITs are trading at a smaller discount. Now FCT is trading about zero point 0.9, very zero point 0.9 plus, close to book value. CMT is trading slightly above book value. But the reason why these REITs are trading at a smaller discount is because typically these REITs tend to be more resilient in a downturn. So I think going forward, the office sector is going to face a lot of headwinds, not just in 2016. I think it is going to last beyond 2016 because the supply that is coming up is 3 times the average annual demand. So you are not looking at just 1 year of pressures on your office rental rates, and then on top of that, you also have a lot of a lot of headwinds facing the office sector. Your banks are downsizing; they are not expanding, and like Capo Reed mentioned, from over the years, the proportion of banks taking up the office space in their portfolio, they have gradually shrank. So that is one of the headwinds for the office sector as well. So they are trading at a big discount for a reason. So I think in turbulent times, in uncertain times, retail REITs tend to hold up better than office REITs, especially for FCT because of the fact that firstly they are suburban, so they are not as dependent on tourist spending. They are also not as dependent on discretionary spending because they are mostly necessity spending. But CMT, you look at, they actually have quite a portion of their malls, their portfolio, which is dependent on tourists as well. You have like Raffles City, you have Plaza Singapura, you have Bugis Junction. All these add up to about 1/3 of their portfolio. So they are trading at a discount for a reason because they are going to face a prolonged period of rental pressures. As for another question on comparing Cash Logistics and Soybit, we we have recently downgraded Cash to a neutral. So as of current prices, we are more inclined towards Soybit REIT simply because of the fact that based on location, Soybit has the more advantageous portfolio. Hi, there's another question on FCT, and the question is that if North Point undergoes AEI and the average occupancy drops to 76%, will the DPU drop as well? So causing the yield to drop as well. So you're right in saying that you're right in pointing out that North Point actually occupies a good percentage of the FCT portfolio. They are one of the two main malls that actually, in fact, other than Causeway Point. So with this AEI, we actually forecast the drop in MPI from North Point alone by a 10% margin this year. But as per our talks with management has actually committed. They will still strive to maintain the DPU growth for this year. This is something which they have managed to done every single year since the IPO. So this year is not going to be an abnormally. They will still try to keep it growing, and there are many ways they can do it. One of the ways is that they can possibly take management units in units, so that could free up some cash for the payout as well. No doubt there will be a bit of dilution if they take more units, but the net effect you will notice that it will still result in an increase in the DPU. So you're right that MPI will drop because of the North Point AEI, but there will be ways that management can work out to still grow DPU. And let's not forget that the past AEI that management has done to Causeway Point, thereafter, after the AEI, they have managed to achieve 13% ROI, return on investment. So post the AEI in 2017, towards the second half, we're optimistic that the increase in the rentals that they can collect after the renovation works will lead growth for the REIT going forward from 2017. Hi, there's a question on the short-term the outlook for STI. Sorry, because our technical analyst just stepped away. I believe we have come up with something on the STI last week. So if you could refer to that post or that report that we have done, or alternatively, if you still have further questions on the STI, you can email our technical analyst, or you can ask your questions again next Monday. So if there are no further questions, I would like to call an end to today's webinar. Uh, okay, I understand that there are some issues with our audio today. There are complaints about it being a bit echoey. Sorry about that. We will try to work that out, and hopefully by next week we will be back with a smoother issue. Thanks for your patience, and hope to see you guys again next week. Thank you.